Have you ever wondered why we're not all millionaires by now? After all, we've been told repeatedly that compound interest is the eighth wonder of the world. Just invest consistently and let time do the work. But if compound interest is so magical, why isn't everyone rich? Today, I'm breaking down the uncomfortable truth about compound interest and why the math that looks so promising on paper rarely translates to real-world wealth for most people. Let's start with a calculation that gets financial advisors excited. If you invest just £200 monthly with an 8% annual return, after 40 years, you'd have nearly £700,000. Sounds fantastic, right? But here's the catch. That wealth accumulation is 40 years away. And with rising inflation, frozen tax bans, and the cost of living soaring, especially here in the UK, £1,000,000 won't buy what it used to. In my video on ISA millionaires, I revealed that in 26 years since ISAs were introduced, only 4,850 ISA millionaires have emerged. That's 0.02% of all ISA holders. So much for the guaranteed path to wealth. Even hitting the £1,000,000 mark inside your ISA doesn't automatically mean financial freedom anymore. Not when bills are up, taxes are rising, and real returns are shrinking. So why isn't compound interest delivering the dream? Three big reasons. 1. Inflation is a silent killer. If you're earning 5 to 7%, but inflation is 3%, your real returns are tiny. According to the Bank of England's own data, many safe investments recommended for compound growth now yield the same or less than inflation. That magical growth barely outpacing your bills. 2. Life doesn't wait. You're told to leave money untouched for 30 to 40 years, but then life throws you curveballs. Job loss, emergencies, rising rent. Nearly half of UK adults have reduced or stopped contributing to their savings, investments, or pensions due to the cost of living crisis. The reality, many people can't afford to let money sit for decades. 3. The market plays games with your emotions. This links to my video, Investing Psychology, the mental traps costing you thousands. You start motivated, then the market dips. You panic, you pause contributions, or worse, you pull out. The Dalber studies show the average investor underperforms the market by 2 to 4% annually due to these emotional decisions. And that kills the compounding engine completely. Most gurus love showing those neat compound charts, but they leave out the key ingredient: consistent increases in income. Compound interest only works when you have more to invest over time. If your income is stagnating and your expenses are rising, you're compounding crumbs. While investing is powerful, it's not an equal playing field. Research shows that the wealthiest households are seeing their fortunes grow far faster than the average person's. According to Oxfam, the richest in society are watching their wealth grow exponentially, often during times of crisis. And data from the UK government shows that the top 1% of households hold over 10% of all household wealth in Great Britain. This isn't just about smart investing, it's about access. The wealthiest have more capital to deploy, better financial advice, and access to exclusive investment opportunities. Most people are just trying to keep up with bills. This is why so many people are starting to question the system itself. In my video, Why Everyone is Leaving the UK, I talked about people moving abroad not just for sunshine, but for a chance at better financial leverage, lower taxes, lower cost of living, higher savings rates. Because the truth is, your environment matters. Compound interest doesn't thrive in a system of high taxes, rising inflation, and limited access to real growth opportunities. So, if compound interest alone won't make you rich, what will? 1. Focus on growing your income. Whether it's a side hustle, freelancing, or career shifts, the single biggest factor in wealth accumulation isn't returns, it's contribution rate. 2. Reduce your investment frictions. Every 1% in fees reduces your final returns. Look for ultra low cost index funds and avoid actively managed products with high fees. 3. Invest through cycles, not just charts. Understand the psychology behind market ups and downs, something I explored in my video, Investing Psychology, because the biggest losses often come from bad decisions, not bad markets. 4. Optimize your environment. Use ISAs, pensions, and legal tax shelters. So, is compound interest real? Yes, it is real, but it's not magic. is a tool, and like any tool, it only works when the conditions are right. The math exists in a vacuum, but your money exists in a complex economic and political system designed to extract value at every stage. Understanding this reality is your first step toward creating a financial strategy that actually works in the real world, not just on a financial advisor's calculator. If you're finding this information helpful, don't forget to hit like and subscribe and turn on notifications so you don't miss future updates. Thanks for watching, and I'll see you in the next video.